are in listen-only mode.
Good evening, everyone, and thank you for joining us. Welcome to Ironwood Wealth Management's Market Insight webinar for the fourth quarter of 2014. My name is Nick Basso, and I'm a Portfolio Administrator in Ironwood's Investment Division. Tonight, it is my pleasure to introduce our featured presenter, the Chief Investment Officer here at Ironwood, Mr. Sean Rogers. Sean is a charter holder of the Financial Analyst designation, and he also serves as Ironwood's primary investment strategist. If anyone has questions for Sean during the presentation, please feel free to type them into the questions box on the GoToWebinar panel at the side of your screen. We will do our best to address all of the questions at the end of the presentation. And now, without further ado, please join me in welcoming Sean to lead this evening's presentation. Sean?
Thanks, Nick. Good evening, everyone. Welcome to another edition of Ironwood's quarterly market insight call. A lot has happened over the last quarter. We've had a spike up in volatility from last quarter, and the environment has changed a bit. We've got oil below $80 a barrel. We've got the Fed ending quantitative easing. So we've got a lot to talk about tonight, so I'm going to just jump right into it. The topics that we're going to cover, like always, I like to kind of do a recap of what happened during the third quarter, go through some asset class returns, want to see what we expect for the rest of 2014, and then finally, how does that affect our portfolios and our investment decisions. So I'd like to start by showing kind of where we've come from, and I know I've done this the past few webinars now, but we keep going higher. So this chart keeps becoming, or it's still prevalent, and I want to make sure that folks aren't just looking at this short period of time, and that they're looking more at valuations and prices in relation to the cash flows that companies are earning. So the reason I start with this slide is, one, first point out that through September 30th, and if you went through today, we'd be looking at close to 200% higher just on the price basis for the S&P 500 from March 9th, 2009, the market bottom. So that's a long way to have come. And a lot of folks get worried because they look at this chart and they say, okay, well, I've been investing the last 15, 20 years. I know the deal. We do really well, and then we drop. And then we do really well, and then we drop. And then we do really well, and the next thing to come is, oh, we're going to drop. Well, that's not always the case, and we'll get to the next slide, which will put the shorter history into more perspective, because we'll look at longer term. But what I'd like to focus on here in this first slide is just to point out, if we looked at different levels of the S&P, we're only getting what the price of those companies bundled together gives us. But what we don't know is the earnings of those companies, and the earnings of those companies over time has been increasing. So in March of 2000, 1527 on the S&P represented 25.6 times earnings is what somebody was paying for that earnings stream. So 25.6 times that stream of income, and that would give you this 1527. So that's a very high multiple. Folks are paying a lot for earnings. The average is closer to between 15 and 16. And you'll see that in 2007, we were right about the same level, 1565, and our price earnings multiples were 15.2. So much more in line versus 2000. If you remember back in 2000, that was the dot-com. Things got a little crazy. There was irrational exuberance, and we had some bubbles created, especially in the tech sector. And so that's how we were able to get to this high multiple. 15.2 is much more in line with long-term historic norms. What we didn't see coming, what no one really saw coming during this period of time, was the financial crisis. And during this time, if we looked at what real estate prices did, we'd see a bubble in real estate prices. And if you wanted to look at the equivalent to the price earnings multiple on real estate, you would have gotten levels that are very historically higher than normal, or saying that real estate was overvalued during that period of time. Currently, and the other things we want to take a look at are our dividend yield. So what is the stock market paying us to hold it for a year? And when I'm talking about the stock market, this chart just shows the S&P 500, but that could be a global stock. That could, we could be talking about any kind of stock here, but in this case, we're talking about the S&P 500, which just is looking at domestic large cap companies. So we look at the dividend yield, and we look at, okay, well, in 2000, the dividends were pretty low. In historical perspective, right around 1.8 to 2% is usually about norm. So, October 2007, September 2014, we're still in the norm there. 10-year Treasury, however, and this is the thing that a lot of folks aren't talking about here, is during the 2000s, the 10-year Treasury was at 6.2. During October 2007, the 10-year Treasury was at 4.7. Currently, as of today, the 10-year Treasury is just above 2.35%. So that all plays in. All of these things affect stock prices. You could make a pretty good argument that with this low rate interest rate environment, this PE multiple could be closer to 20 and not be overvalued with a 10-year Treasury at 2.5%. So anyway, we're just taking a look at these three tops here and putting it into perspective. 15.2 is not expensive. It's definitely not cheap. It's not as cheap as March 2009 when PE multiples, forward-looking PE multiples, were 10.3. Dealing with clients during this period of time, if you would have told them that we wanted to, jump in with both feet first and buy stocks, they would have looked at you like you were crazy. But this is sometimes the when it feels the worst to be investing in stocks, sometimes that pays off the most. It sure did over the last 5 years or so. Anyway, when we put this into a longer term perspective, it kind of gives us an idea of, okay, well, exactly where are we and what should we expect? And we see that we have a consistent pattern here of long periods, 10 to 20 years of bear market periods where we're roughly flat with the stock market, followed by some pretty dramatic upswings, and then some flat markets, and then upswings, and then flat markets, and potentially an upswing. They call these bear and bull markets. So we just went through a pretty bad bear market from 2000. And now it appears that we could be in a bull market. We are in a bull market. It will depend on how long the bull market lasts. But this gives you a little bit better perspective versus this chart here. So just wanted to point that out and kind of put things into perspective before we jump in and look at Q3's results. So Q3's results, there's a little bit of a divergence going on, and talking with investors and clients, a lot of folks who we deal with obviously are here in the United States, and the indices that we commonly look at are the Dow Jones, the S&P 500, and the NASDAQ. Those are all domestic stock indexes, and all of the media, both on the TV and online. You can't really you can't really maneuver through too many websites before you see, how the Dow, the NASDAQ, and the S&P are doing during the day at some point. Or if you turn on the TV, any of the news stations, you'll likely see those three. Well, that doesn't tell us how the world stock market's doing or how international or emerging markets is doing. And during this quarter especially, and for the most part for 2014, there's really been a divergence in asset classes, and we'll go over that later in the presentation. But for Q3, we had the S&P 500. It was actually up 1.1%. Although international, if you looked at developed international, it was down 5.8% during the same period of time. So there's quite a difference there. And then emerging markets was down 3.4%. And if we looked at commodities, they were down even further than that. The 10-year Treasury was about flat, 2.53 to 2.52. But during the fourth quarter so far, we had a lot of volatility with rates. Europe slowing down. There were some culprits there, but we actually had a 10-year Treasury that went below 2.2% for a few days. So we'll talk about that, and we'll talk about the Fed here in a little while. ISM data for the U.S. has been fantastic. Most leading economic indicators for the United States have been pretty solid. When you look at them, they look really healthy. It doesn't look like an economy that's faltering at all. Doesn't look like an economy that's being affected by global slowdown. It looks like a strong economy. We look at the job market, unemployment rate at 5.9%. We'll get another reading tomorrow during the jobs report, the employment report. Weekly jobless claims have been under 300,000, excuse me, consistently for the past couple of months. So all of these things are good for the U.S., but I'm guilty of this just as much as anyone else. We focus a lot on the U.S. because that's where we live and that's what we know. But there are other markets, and we'll discuss some of those here later in the presentation as well. But the U.S., it is the biggest economy, and it's going to drive a lot of the global growth as well. And it's going to, how the U.S. does is going to help emerging markets, is going to help Europe, and ultimately is going to drive global growth. So here's that divergence I was talking about. We'll take a look at here the third quarter. Like I said, the S&P was up 1.1, but look at these other asset classes down here, especially these last four. We've got emerging markets down 3.4, developed international down almost 6, small cap down almost 7.5, and then commodities just taking it on the chin, down 12% during the quarter. And if you look at it year to date, you'll see that the S&P 500 domestic large cap companies are up 8.3, when we've got small caps down 4 and commodities down 5 and international down 1. So you've got a big divergence between some of your asset classes. That gives us a great opportunity to rebalance the portfolio and sell from asset classes that have done well and buy asset classes that have done poorly. You'll see from this chart, and this is just the last 10 years, none of the asset classes really stay in the same spot. 2004 through 2007, the places to be were REITs, emerging markets, international, and commodities. You can kind of see those are all at the top here. And then shortly thereafter, some of those are down here at the bottom, emerging markets, commodities. And so international down here, down 43% during the recession during 2008. So it's not about which asset class. It's not about picking the best asset class each year, because you just look at this chart and there's no really pattern here. But we can do rebalances and have a very disciplined investment strategy, which is going to, when we rebalance, we're going to be selling from things that have done well, so selling high, and then purchasing things that had done poorly in a relative relationship, so buying lower. So that's exactly what we want to do, and that was one of the things I wanted to bring up there in that slide there. Like I said, the U.S. economy is continuing to improve. The second quarter GDP, we grew at 4.6. We just recently got the third quarter first estimate of GDP. The first estimate came in at 3.5% growth. So that 4.6 and 3.5 are very good numbers. It looks like for the year we're going to be close to 3%, which has been our long-term average. But there is one thing I want to note on this slide. Right around 85, we had a shift, a demographic shift, where our population started to increase at a slower pace, and population growth is one of the main drivers of GDP growth. And if you were to take the average for the time period from 65 to 85, you get a GDP growth that was much higher than 3%. And if you took the post-85 GDPs and you averaged them, you'd get about 2.5%. So there was a big demographic shift in 85 with the population growth, and so the speed limit of the economy measured by GDP, we have the long-term average shown here as 3%, but it's really more like 2.5%. That's what the more recent history has given us as the speed limit, and that's really what we've been projecting to kind of benchmark against. So 2.5% is more of the long-term average that we're looking at. So 3% is above that number, and we believe that that's going to help. That's going to only help the Fed exit their quantitative. Well, they're done quantitative easing. We'll get to that a little bit later, but start to tighten their monetary policy, which could drive up interest rates. So growth is definitely something we want to keep an eye on. Some of the main factors of that growth are from our cyclical sectors here. I know I've hit on this many times in the past, but we've got our auto sales. That's a very positive trend, and we're above average. If I were to update this housing starts number, we actually were above 1 million units in September, which is the first time in a long time that we've been above 1 million units. So that's a very positive. That's a very positive piece of news, given that the housing sector is a big piece of the economy. Auto's not as big, but housing improving definitely is going to help. Now you can see it's pretty choppy here at the end, and that has to do with interest rates fluctuating. That'll continue to happen, especially if interest rates start to increase. You're going to start to see housing be a lot more choppy with increased interest rates, because we've all gotten used to these cheap mortgages. Inventories are tight, so that's good. And then we've really had a tick up in real capital goods orders. In fact, you can see this big jump here at the end, and then we kind of went sideways there. And if I updated this to September, we kind of went sideways again, but much above the average. So cyclical sectors look very good, which is just more evidence that the U.S. economy is doing well. Consumers are feeling a lot better. Net worth is up 14 trillion over the past 2 years. Debt is actually down 8% since 2009. The most recent reading, you'll see that debt actually ticked up a little bit, which is telling us that consumers are feeling a little bit better about their situations. They went and paid down a bunch of debt in the tune of 8% pay down during these last couple of years since 2009. And actually that's starting to tick up now. There's a combination of things happening. One, banks are more willing to lend than they were previously, and consumers are more willing to take those loans for new cars, for new homes, for purchases, these sorts of things. So we don't want to see that number go way up, but it does show that folks are starting to feel better. And then this is another chart that's going to show that same thing, and I actually want to go into a little bit more detail here. If we updated this through October, we just got October's numbers. October's consumer confidence was 86.9. So, you know, we're continuing to go up. We're above this average now. If we were to plot it, it'd be right about there. And that's to be expected. And if we look at the things that impact consumer sentiment, we can take a look at just these four, and I'm going to just make comments on each one of them. But a 10% year-over-year rise in gasoline prices equates to negative 0.8 points. Well, gasoline prices have actually decreased more than 10% this year, so that's going to be an addition of about 0.8%, or I'm sorry, 0.8 points. Year-over-year rise in home prices, we've had that. Year-over-year rise in the S&P 500, we've had that, so that's going to benefit our number. And then year-over-year rise in unemployment rate would be a -5. So this one definitely, the unemployment rate is the one that affects this number the most. We've had the unemployment rate come down significantly over the past year. And so that's one of the factors that's helping this consumer sentiment, just making people feel better. So talking about this unemployment rate, in August we were at 6.1, September 5.9. We get another report out tomorrow, and we'll make sure that we're keeping an eye on it. You can see jobs have been being created at a pretty good pace. The last 3 months we've averaged just over 200,000 new jobs per month, which is very healthy. You know, it's not the 300 and 400 numbers that we have seen in previous recoveries, but when you have this much job growth over a 5-year period, that's pretty good. And there's a reason for that. It's because we lost 9 million during the recession. So, you know, a lot of that is getting back to where we were. And the other thing I want to talk about when I talk about the unemployment rate is that there's a huge structural shift or issue that's actually pushing the unemployment rate down probably more than it would have been otherwise. And that's the fact that we've got the labor force participation that has gone down significantly over the last few years. The biggest driver of that is the fact that if we go back to this slide here and we see, okay, household net worth is up by 14 trillion. If we add to that the baby boomers are starting to turn 65 now, you've got a lot of folks turning 65, and you've got asset levels where we have $14 trillion more in net worth than we had 2 years ago. And so you've got a lot of people saying, you know what, I'm sick and tired of working. I'm turning 65. I'm gonna go on Medicaid, Medicare. I'm gonna start Social Security. My 401k or retirement plans are doing pretty well. I've got enough money. I'm gonna call it quits. And so there's a lot of people that are retiring, and those folks are being no longer counted in the labor force. So when that happens, if you only have 200,000 new jobs, you can actually put a dent in this unemployment rate if that labor force participation rate is also coming down. So there's definitely a structural issue. So you know, it's difficult to compare the unemployment rate in today's environment to, let's say, 10 years ago. But at least it gives us an idea of which direction we're going, and you can see that clearly back from the recession, the job market is improving. Inflation, we were a little worried about last quarter because the numbers had ticked up. Headline CPI was actually above 2, and core was at like 1.9. So they've actually come down. That's due to, well, there's a couple factors, but that's mostly due, we believe, because of the European slowdown and the commodity prices and the dollar increase, which we'll talk about here in a little while too. But you can see, that gives the Fed more confidence in, okay, we don't have to tighten monetary policy too quickly, but their target is around 2% on inflation. So we're still well below that. Interest rates and the Fed, that brings us to the Fed and interest rates. So like I said, interest rates have been going down for the last 30 plus years, and this last quarter they didn't really move all that much. when we saw a slowdown in Europe, a potential triple dip recession in Europe, rates plummeted down to below 2.2% there for a little while, and since then have come back up to 2.38% as of this afternoon. But you can see that over this long period of time, we've been in a real bull market for bonds, and we believe that there's a lot of issues surrounding fixed income that we'd just be really careful with. One of the biggest issues here is the unprecedented monetary policy from the Fed. And a lot of folks are very interested in this, and rightfully so, they should be. Last week, the Fed came out and announced that they were stopping quantitative easing. And just for those of you who haven't been on a call where I've explained quantitative easing is where the Fed prints money and buys treasuries and agency mortgage-backed securities, typically from financial institutions. So they're giving financial institutions liquidity, they're giving them cash that they printed, and they're taking assets out of the market. What that does is that increases the Fed's balance sheet on the asset side. So you can see they've been buying U.S. Treasuries and agency mortgage-backed securities. Well, now that they've stopped that program, this line should level off. They have said that they still will, when these securities mature, they're going to roll them over into new securities. So their balance sheet, their assets should stay about the same level. At some point, they're going to have to mop up this liquidity. And the problem that we have now is that economic impact that the Fed has had for quantitative easing QE3 has been really, it's not economical. It's more psychological than economical. And I'll show you why here with these charts. So here's their assets, and their assets are increasing, but you can also see that their liabilities are increasing. In particularly, the excess reserves are increasing basically in lockstep with the increases in assets. So what this is telling me is that the Fed is going to banks saying, here's cash, Mr. Bank. I'm going to take some of your treasuries out of your hands. So they take the treasuries, and then the bank says, well, I don't have anybody to loan this money to, so I'm going to put this money back to you, Federal Reserve, and I'm going to keep it on your, I'm going to keep it as a liability on your balance sheet as an excess reserve that I don't need to keep, that I'm going to put back on you. So it's like the Fed taking money out of their top right drawer of their desk and then putting it into the bottom right drawer of their desk. They have, economically speaking, they haven't done anything. The reason that monetary policy works is if we're not in this situation where we're pushing on a string, this is pushing on a string. If we're not in this situation, then what happens is the bank will then go and find folks to lend that money to. Then those folks who borrow the money will go do something economical, and there's economic activity that happens with every dollar that's lent out. And that turnover is known as the velocity of money. Well, the velocity of money has gone from 10 before the recession down to about 4 post-recession. And we're only now starting to see that tick up, and we're only now starting to see banks wanting to maybe loosen their policies. So we've got to be careful because there's a lot of liquidity, and if the banks start to lend that out and the velocity kicks up too quickly, it could cause it could cause inflation. It could cause the growth of the U.S. to really go at a very heated pace, which could cause some asset misprices. So we want to make sure that we're staying on top of that. And if we see the stock market at a 25 multiple, that should tell us, okay, maybe there's something going on here that doesn't make too much sense. So we definitely want to keep this. The other thing is we don't have a playbook for the Fed's balance sheet that looks like this. They're going to have to increase interest rates, and they've said that they're going to increase interest rates in 2015. That's gonna slow the economy down as they do that, especially in the housing market. Now we're all used to these low rates, but it wasn't that long ago that a 6 and 7% mortgage rate were the norm. And now if we're not talking about a 4% mortgage rate, we're thinking it's way too expensive. So there's going to be some issues, and there's going to be some volatility as the Fed cleans this up. And so we've got to make sure that we're paying attention to asset classes and relationships between asset classes. We have to definitely watch what kind of fixed income exposure we have, because it's all gonna be very volatile with each step the Fed makes. This is going to show all of the quantitative easing here. So recession happened. The Fed came out and said, we're going to do this quantitative easing. The market liked it, and then we had some more issues happen, and then we dropped even more. And then the Fed came out and said, okay, we're going to really pour some quantitative easing in, and they did QE1 expanded, and the market liked that. And all the Fed was trying to do at the time was inflate asset prices so we could stop this deterioration of asset prices. The first time QE1 ended, or the only time QE1 ended, but QE1 ended, the market pulled back 16% during that period. The Fed got worried again, and Ben Bernanke came out and he hinted, okay, maybe we'll do quantitative easing again. So the market liked that. Quantitative easing QE2 ended, the market dropped 19%. Operation Twist was announced, and then later QE3 was announced, and since then the stock market has done very well. Now in October, QE3 ended, and right before October the market dropped about 9%. Now that's not nearly as bad as 19, and it's not nearly as bad as 16, but I'd say that if you think about where the U.S. economy is versus where the U.S. economy was back in 2011 and 2010. 2010, we were all still reeling from the recession. Even 2011, there was market turmoil so the economy was not fully on its own 2 feet. Now the economy is growing at a much stronger, healthier pace, and so we believe that the Fed made a smart decision with ending quantitative easing 3 and continuing with their game plan of increased interest rates in 2015. And we believe that's going to continue to be the plan, and we continue to believe that the U.S. economy is going to continue to do well. So I talked about banks and the velocity of money. This just backs up that banks are playing it real safe. You can see common equity as a percentage of total assets is at the highest level it's been since the Great Depression. So 11% as of 2013. The last time we saw that was, back in the 30s. So they're playing it real safe. Growth of real estate loans, where the big damage was done in the recession, it's growing at 2.5% here. The average approved mortgage FICO score is 743. You can see that that's a dramatically increased number compared to where we were in 2000 and compared to where we were in 06, 07, when you're under 700 is the average approved mortgage. So now the average is 743. That's a very substantially higher number. You can see that banks are being real picky, and they've tightened up their standards dramatically since compared to the last decade, let's say. High yield market, I've made a couple comments. We've actually changed our bond portfolio. If you own bonds in your portfolio, there's a high likelihood that we made trades in your portfolio during August of this year, where we saw this high yield spread, which normally is at 6. It got down to 4. Basically, that's saying, okay, the normal high yield spread from a high yield bond to a comparable 10-year Treasury, the average that we're getting paid is almost 6% higher than that Treasury. The spread got down to almost 4%. We were not getting paid to take high yield type risk. So we made a decision to lighten up our position in credit sensitive type bonds. And that rate, this was as of September 30th. That rate as of October 31st is now almost 5. So we actually were able to avoid when a spread goes from 4 to 5. That means that all else equal, the rate is going up by 1%. If it goes from 4 to 5, that's if rates in general are staying the same. That is a negative thing for the bond price. Now you couple that with rates went down a little bit in October. They didn't go down. They didn't go down 1%. So you ended up with a higher yield for high yield bonds, which then means their prices went down. So that our paring down our credit risk has been a positive thing for the portfolio since August. Now that the high yield spread is closer to 5, we're getting more interested in this area again because now we're getting paid a little bit more for the risk that we're taking in that area. So we'll probably be making some changes in the bond portfolio here very shortly. This just shows the impact of an increase or decrease of 1% in interest rates. And I've talked about this one a lot, but for those of you who haven't been on a call before, if we have an increase or a decrease in interest rates, your longer term securities, so your 30-year treasuries versus your 2-year treasuries, will be impacted more by an increase or a decrease in interest rates, a lot more. So a 30-year bond, if we have a 1% increase in rates, so if the 10-year treasury goes from 2.38% where it is now, if it goes up to 3.38% over the next year, if you hold the 30-year treasury, your 30-year treasury is going to drop in value approximately 17%. Likewise, if the rate were to somehow go from 2.38% to 1.38%, it could happen. It would be very far-fetched, but it could happen. Your 30-year treasury would appreciate in value by 22.7% roughly. These are effective durations. We're trying to find out an impact of a 1 a positive or negative 1% change in interest rates. So you can see you have a lot less interest rate risk, you've got more interest rate risk, you've got a lot of interest rate risk. And then same over here. Floating rate securities, you don't have a lot of interest rate risk. You might have higher credit risk, but you don't have very much interest rate risk. And as we go down, you get more and more interest rate risk as we go down this list here. So that's one of the things that we've been concerned with for the last couple of years. So far, rates have stayed low. I'm going to continue to say that with the Fed increasing rates and stopping QE, I think the writing's on the wall now. We're going to start to see interest rates increase. So we want to be very careful on the bonds that we do own. Now, what does that mean for stocks, increasing interest rates? So this chart shows us the correlation between stocks or weekly stock returns and interest rate movements. So there's actually a positive relationship when interest rates are increasing as long as they are lower than 5%. So you can see we're at the 10-year Treasury right now is 2.38%. So as long as that's below 5, it's actually a positive thing, or it has been in the past, a positive thing for S&P 500 returns as we move toward a higher interest rate. Usually means the economy is improving, which means stocks are doing well. Now, there's a point at which too high of an interest rate starts to have a negative impact on earnings and the economy. And then when we have interest rates increasing and it's above 5%, you can see it's a negative relationship excuse me, between yield movements and stock returns. So right now, in the short run, increased interest rates are most likely a positive thing for our stocks. International. So this is where I'm going to spend a little bit of time because there's a lot going on here. So third quarter, I mentioned the international just did not do as well as domestic. Well, what I did not talk about is in relation to the U.S. dollar. So if you look at, okay, third quarter, the U.S. in U.S. dollars, we're in U.S. dollars, the S&P was up 1.1%. Well, if we looked at developed international in local currencies, stocks were up 1%. But if we translate it to U.S. dollars, we actually lost 6.8% when we translate it to U.S. dollars. And you can see that that wasn't just the case for large cap, for developed international, excuse me, but it's the case for emerging markets, Pacific ex-Japan, Europe ex-UK. You can see that there's a huge difference between the U.S. dollar return and the local currency return. One of the positive things about international over the last year or so is that correlations have started to come down a lot. And so adding international or having international in your stock portfolio has brought down your overall volatility. And that is seen by these correlation numbers here in correlation to these different countries here. So correlation is the lower correlation we can get, the more benefit it is to add that asset class from a risk perspective into your portfolio. So as a portfolio manager, we like asset classes that have low correlation to each other. It helps offset risks. But getting back to this dollar difference here, the main driver of this is the differences among global monetary policy. So I've already talked about the Fed. They just announced last week they're stopping quantitative easing. So this is a chart right here of central banks' assets. The Federal Reserve since 2008. Basically, 2008 happened. Every central bank decided to increase. We had a coordinated, easy monetary policy trend. In 2010, 2011, Europe really put the pedal to the metal, and then they stopped and they brought that back down. And that is one of the reasons that they caused themselves that double dip recession. And soon, if they don't do anything, it could be a triple dip recession. Now, just today, Mario Draghi came out this morning and basically told the markets, look, if we have to, we've got a trillion euros to implement a quantitative easing program of our own. So the markets are taking that as, okay, Europe has a potential for increasing this global monetary policy. Whereas the Fed has just announced that they're stopping quantitative easing, and oh, by the way, they're going to start to increase interest rates sometime next year. So the Fed is going the reverse way. Last Friday, the Bank of Japan came out and said, we're going to do more easing. And they've already done a lot, but they continue to try and get themselves out of this low interest rate deflationary type environment. The differences in these monetary policies has made a dramatic impact. This is the chart of the dollar index, and you can see that over the last 4 months, the dollar has gone up about 8%, which makes up almost all of this difference in some of these international, if we translate them to dollars, during the third quarter. So really the dollar increasing and appreciating in value was one of the reasons that some of our asset classes didn't do as well as, let's say, domestic asset classes did. If we look at on a more global scale, kind of what's going on, you can see that where these green numbers are, U.S. and Canada, you can see Ireland's doing pretty well, India's doing pretty well. The global economy, it's staying about steady. And if we updated this with October's numbers, they'd look a little bit better. Anything over 50, we're growing. And so you can see the Eurozone is just barely growing, and you've got some of the economies that are contracting here. But on the whole, we're still growing. U.S. is growing like gangbusters, and then the rest of the world is kind of trugging along, and we've got a 52.2 number, and if we looked at October, it'd be right around there, slightly higher. Not huge global growth, but you've got one of the biggest economies that's really pulling everything up, and so that's adding to this dollar appreciation, as well as the monetary policy differences. So let's focus on Europe for a little while, because I think there's actually some opportunity in some of these developed international areas. So I want to spend some time on this and make the case for it here. But we see that Europe is kind of where the U.S. was back in 2011. They're talking about this huge monetary policy that they could infuse. They've got high unemployment rates. So they're going to have, as these unemployment rates come down, if they were to do a monetary policy, if they were to increase or ease monetary policy, and it was to have a positive impact on their economy, and these unemployment rates were to come down, that'd be a tailwind for Europe. Just like it was a tailwind for the U.S. over the past 5 years, where we've gone from 10 to 5.9. If Europe can go from 11.5 to, say, 8, that's going to be a real good tailwind for them. Inflation's low for the Eurozone, so the ECB won't have to really worry about that. The other thing that they've got going for them is they did take austerity and it had a huge impact on their growth from 2010 to 2013. This is an estimation of fiscal drag for each of these countries. So you can see between 2010 and 2013, we had a negative 3.4% drag on from the government, so that they were decreasing spending. Well, 2013 to 2016, that number goes down to 0.7. So you have a positive in a possible easy monetary policy, and you have less government drag. So that could play into Europe's favor, and we're starting to see some attractive levels throughout some of the international areas, and the strength of the dollar makes that even more prevalent. So although it's going to be volatile, we do believe that that kind of going in some of those areas that are out of favor, it might not make sense tomorrow, but over the long run, we believe some of these underappreciated areas could unlock some good potential value for us. And here's just looking at international equity earnings and valuations. So you can see since the financial crisis, emerging markets had a real good earnings per share increase. They got back to new highs, and then since then they've kind of pittered off a little bit. The U.S. Is the gray. We got back to our old highs, and then we've just kept going. And Europe never got back up there, and that's because there was a difference in monetary policy, and that really had an impact. And then if you look at valuations or PE multiples, we can see S&P, and this is over a different time frame, so that's why the numbers are a little bit different. But you can see 15.3 versus 13.8, 13.9 versus 12, and then look at emerging markets, 10.8 versus 11. Emerging markets right now looks very attractive in this interest rate environment. With low rates, we can argue that that PE multiples should be higher, and when you look at emerging markets, not only is it not higher, but it's below its average for the last 10 years even. So we really believe that emerging markets is poised to do very well. It's going to be one of the most volatile pieces in a portfolio, but we believe that long term we're going to get paid commensurate with the risk that we take. And this is just another way to look at it. Once again, these are long-term historic averages. We could make the case that with interest rates as low as they are, that these brown lines for averages are really not fair market value, let's say, in an interest rate environment like this. So you could argue that these blue dots should be higher than the brown lines with this interest rate environment. You can see United States, we're higher, and we're getting more expensive each day that the S&P gets higher. If we don't see that earnings growth, then that PE multiple is going to just keep increasing on us. So that's one of the reasons that we went and feel confident selling some of our domestic that's done well and purchasing some of these other areas that have not done as well. Developed international, you can see it's more closely related with its long-term average, but like I said, you could argue that should be higher. And then if we look at emerging markets, we're below the brown line. Once again, you make the argument that we should be above the brown line, and we're not even to the brown line. So that's one of the areas that we do really like. S&P earnings, quarter 2, $29.45 per share. Quarter 3, we were at $29.74. So 2 quarters in a row, all-time highs for earnings for the S&P 500. If we were just to say, okay, let's just take $30 a share, let's multiply it by 4. The next 12 months, we should be at about $120 of earnings for the year, and that's assuming flat growth on the earnings, which with the economy running like it is probably an underestimation. But let's just go there for now. And if we're to put a valuation of 15 times $120 a share, that gives us an S&P value of 1,800. If we were to put a 20 multiple on that, it gives us a value of the S&P at 2,400. So right now, we'd be a little cautious on the S&P. Things tend to go in one direction or the other. So you could definitely make the case that PE multiples could easily get to 20. And you can make the case that earnings are going to be 10% plus earnings growth for next year, which would make those numbers higher. So we just want to make sure that we're paying attention, that we're not getting lulled to sleep by domestic equities just because they're doing so well. Companies are having these great earnings, and they're not even using leverage. You can see that the average leverage over the last 20 years or so has been 169%, and we're just above 100%. So companies are doing this with less risk. When they start to increase this leverage, we're going to start to increase these earnings per share numbers, but then leverage can be a dangerous thing. It could be it's going to make those numbers more volatile both directions. It can make them higher, and it can make them lower faster. So those are definitely things that we want to keep in mind. These are just yield alternatives here. We've got equity dividends for different countries here versus their 10-year government bond. What would you rather buy? A 10-year Treasury earning 2.3% over the next 10 years, or the S&P 500 earning 2% per year plus having earnings growth potential? I'd strongly argue that if you had 10 plus years, you should be looking at stocks right now versus fixed income. And then we can see REITs are at higher yields than their 10-year government bond yields. But we also want to make sure that we're not reaching for yield either. And that's something that the real estate market has done really well, and yields have come down a little bit, and prices have come up. So that's another area that we're a little more cautious on is the REIT space. It's not that we're going to completely liquidate all of our REIT holdings because they still are giving us a good yield, but we're just cautious there. We're a little bit underweight from where we normally would be. Cash is still not paying us anything, and there's a lot of it out there. That's basically what this slide is saying. So that could, when that cash either goes into other investments, being bonds or being stocks or commodities, at some point this cash is going to be sitting here earning nothing for too long, and folks are going to start to make decisions to try and start earning a little bit better rates of return on their cash, and institutions are going to have to do the same thing. So that could be a positive when this cash gets deployed. We've seen a huge, since the recession, we've seen a huge advantage into bond funds, but more recently, so you can see this is the total into bond funds since 2007, 1.4 trillion, and then 650 billion, I'll round up, since 2007 into equity funds. And that gap is starting to close. You can see it. It started in 2013. Go figure. When stocks are up 25-30% on a global basis, people start to put money toward those areas, and then the valuations get out of line, and that's how we create mispricings. It's not horrible right now, but you can see there's definitely been a bias toward equity over the last 2 years versus fixed income. where we saw the exact opposite directly after the recession. This is one of my favorite slides here, and what it does is it shows us the relative value between stocks and bonds. And I think just looking at 2 periods here, it just shows us where we can have conviction. And it might take a while, but you know, back in 99, 2000, you had bond yields at a much higher. You had bond yields at about 8%, and you had what's called the S&P 500 earnings yield, which is just the inverse of the PE. So you just flip it, and it basically it's trying to show the S&P as an earnings yield or more like a fixed income. And so you can see the S&P was giving us like 4% versus bonds were giving us above 8. So what this is telling us is bonds were a relative better bet in 2000, 99, 2000 versus their counterparts stocks. And that completely reversed when the recession hit, and we saw this big gap in the opposite direction where stocks had a much higher earnings yield versus bonds, and we still see that gap there. And so we're you know, that gives us confidence to still be more positive on bonds, or I'm sorry, on stock than we are with bonds. PE multiples over short periods of time, they don't really matter. You can see PE multiples and 1-year returns all over the map here. Yeah, you tell me the PE multiple, I can throw a dart and maybe tell you what the 1-year stock performance is going to be. When you give me 5 years of returns after a PE multiple is low, I can give you a lot better idea of where we're going to be annualized for that 5-year period. So PE multiples of 15, we still have we usually, I mean, we're in the vicinity where we have pretty good returns over the next 5 years when PE multiples are close to 15. So, you know, we're not getting stretched by any means, but, you know, especially in this interest rate environment, but we are headed in that direction. So we want to make sure that we're keeping an eye on that. And the biggest thing, and I think this is real prevalent now that you know, the S&P is doing, the domestic large cap is doing the best out of any of the asset classes. We really need to bring this slide up, and it's just showing, okay, you've got S&P, you've got EFA, and you've got bonds, domestic bonds. You've got 3 asset classes, and from 94 to 2013, the return of this portfolio has been 8.02 with a standard deviation or volatility or a risk of 10.64%. If we were to add some asset classes that have low correlation or possibly even negative correlation, which is a portfolio manager's best friend, is low correlation or negative correlation, we can actually put these asset classes into the portfolio, reduce the standard deviation, reduce the risk that we're taking by almost a full percent, and barely give up any of the return by doing so. And so that's the benefit of having a diversified portfolio. When you add asset classes that have low correlation, we can get some of this benefit of a reduction in volatility without giving up a lot of the return. This is just average investor. Usually doesn't do as well, usually because they don't have the correct time horizons. You know, the average investor Dalbar study done each year is showing that the average investor earns about 2.5% when some of these other asset classes have done much better over the same period of time. It's just showing that folks will look at that periodic table of investments. Do I have it in here? No, I don't. I'd have to go all the way back. But they look at that chart and they say, okay, well, S&P did the best so far this year or last year. I'm going to put all my money in the S&P, and inevitably the S&P will correct, and then folks will say, well, I didn't sign up for this, and they'll move to a different asset class or a different fund. and that constant moving versus having a diversified portfolio that we rebalance constantly, that jumping in and jumping out based on emotion is really what causes investors to get a poor return in comparison to some of the other indices over the same period of time. And then this final slide, one of the final slides here, I always end with this because I think it's one of the most important things is, your time frame has to be correct. If you've got 1 year and you're going to use this money in 1 year, there's no reason that you need to be in stocks. There's just too much volatility. We don't have a good bearing on where this portfolio is going to be if it's all in stock and you've got to use this money in 1 year. Even a 50-50 portfolio, there's a chance that we have a negative 15% return. Well, who's going to want to invest money to 1 year later have to use it at 85% of its value? Most people don't sign up for that either. So if somebody has a 1 year time horizon, we're telling them, look, we need to look at cash type investments. We're not going to get paid a lot, but you're not going to lose money in those types of investments. Now, if you have 5 years or 10 years or even 20 years, now we can start talking about, okay, stocks are going to give us a lot better bang for our buck, and we can expect a lot tighter deviation from the returns over 20-year periods than we can over 1 year periods. So just like to have this slide in here. Another one that I like recently, and we sent out a letter that went over this. We sent out an email. The last 2 years have not been normal, have been unusual, and the unusual pattern is that we have not seen volatility the last 2 years. And if I were to update this chart through through October 31st, we'd actually see a -7 right here. And intraday, that even got to about -8, -9, and then came back that same day. But closing prices, we saw a -7. And I'd even tell you -10 is not normal. So the last 3 years, we've seen a -7, -6, -10 intra-year correction. That is not a lot of volatility. And so investors have been lulled to sleep a little bit. And I just caution everyone, if we're in stocks, there's going to be volatility. This is not normal. Seeing our stocks just go straight up in value is not normal. What's normal is if we look at the last 34 years here, the intra-year drop average is 14.2%. Although even with an intra-year average drop of 14.2%, 26 out of 34 years we're still positive. So even though this I'm going to call it pinkish purple, the worst part of the year we were down, the average of all these is 14.2. For most of the years, call it 75% of the years, we end positive for the year. So these last 3 years have been unusual years, and I just want to caution investors to say, don't get used to that. There's a reason that in equities we get paid more over the long run, and it's because we have to stomach periods of time where we drop 19, 28, 49 percent to get those higher longer term rates of return. So just remember, for every positive 30% like last year, there's going to be a negative 10, 13, 23% year that we have to suffer through. Investment implications, commodities have really taken it on the chin. I talked about oil price at the very beginning being below $80 a barrel. A lot of that has to do with the dollar appreciation. A lot of that has to do with the United States finding a lot more oil here with new technologies. But commodities in general have just really taken it on the chin, and we don't believe that that's going to be a long-term trend, and we do believe that commodities are poised to increase with where the Fed is, where global monetary policy is. So that's one of the pieces that we're a little overweight in the portfolio right now. Market neutral as a alternative to some of our safer assets like our fixed income. We prefer market neutral over some of our fixed income. And then I know I've said it a lot during this presentation, but we're very bullish on emerging markets given the last 5 years and the performance and the earnings that we've seen and the valuations that we currently see. Underweight, we believe interest rates are going up, so therefore we're underweight long duration fixed income for the reason that I showed you in that one slide that showed the if interest rates increase by 1%, what does it do to our principal of our fixed income instrument? And then domestic equities. We don't hate domestic equities. We have a big chunk of them in our portfolio. We just prefer developed international and emerging markets over domestic equities at these levels. I do have one of these in here. Okay. So, I was talking about the Dalbar study and having, people look at these returns and they're like, okay, REITs have done really well, 2010, 11, 12. I'm going to go into REITs with a lot of my money. And then they go in there in 2013 and they maybe sell some of their S&P, which didn't do as good during 2011 and 2012, and then they miss out on a 32% year, and REITs are only up 2.8%. So that's what I talk about when I'm talking about investors are jumping different asset classes depending on where they're going here. But I just bring this last slide up to show that a diversified portfolio over the last 10 years, including 2008, where we saw multiple asset classes take it on the chin, we're still up 7.2% per year, or basically 100% return during that period of time. Most of you have heard of the rule of 72. The last 10 years is the rule of 72. You earn 7.2% from a diversified asset allocation, and your portfolio doubles. So that's why I bring this last slide up. I thought that was pretty neat that you can actually, over the last 10 years, in 2004, if you promise somebody, you've got the 10-year rule of 72. If we earn 7.2%, your money will double. Well, that exactly happened in a diversified portfolio over the last 10 years. So I thought that was pretty neat. With that, I'm going to open it up to questions. Nick, if you'll take it away.
Hey, thanks, Sean. At this time, as Sean mentioned, we'll open up our webinar tool panel to any questions from the meeting attendees. Please feel free to use the chat box that is located within your GoToWebinar tool panel, or the question box. I think either way we'll be able to view any of those, and we'll give everybody a few moments to gather their thoughts and to enter any questions or comments that they may have. Well, for the sake of time, we'll go ahead and conclude the webinar tonight. We certainly thank everybody for your attendance, and we look forward to having everyone back in about 90 days for the first quarter of 2015.
I'd just like to say thanks for everybody tuning in, and we'll see and talk to most of you before the end of the year. But if we don't, have a great New Year's, and we'll see you in 2015. Take care. Bye.